My name is Cray Blodgett. I am your partner advocate. Today's topic is equipment financing. If you don't have my contact information by now, you can find it in any of the emails that I've sent you recently. I would bet a Starbucks gift card that I'm the only Cray Blodgett in your inbox. So if you just look up my name, Cray, at loanspark.com, you'll find all of the emails I've been sharing with you all recently. You'll have an opportunity to book one-on-one time with me as well by using that Calendly link. And you can reach me any time of the day by phone or text as well. For today's topic, we'll be covering equipment financing. As a best practice tip, equipment financing is used to help small businesses purchase the equipment they need to grow or operate without incurring the entire cost of the purchase up front, and prevents them from liquidating the cash reserves. No business owner wants to use all of their cash reserves to purchase equipment. So let's get into equipment financing here. First of all, what is equipment financing? Well, equipment financing refers to the process of acquiring any tangible or hard asset for a business through the use of a lease or a loan. Our financing programs include financing of titled equipment, which would refer to any type of vehicle, or in some cases a trailer, tractor, basically anything that would be on the road with a license plate, as well as other types of equipment as well. Think kitchen equipment, laptops, printers, that sort of thing. According to the Equipment Leasing and Financing Association, 79% of U.S. companies use some sort of financing when acquiring equipment. So keep this in mind when you're speaking to your clients who own businesses, because chances are you can help them service their existing needs or generate new business through these types of programs. Equipment financing is a fairly broad term, so I'd like to break it down into two main categories. We've got leases and loans. So a lease is a contractual agreement that's used to finance the asset for a temporary period of time. Typically, at the end of the lease term, the asset would be reclaimed by the seller or purchased by the lessee, who's your borrower, at its current market value. Most of the time, there's a small payment during the end of the term to transfer ownership to the borrower, and we have programs in place where this payment can be as low as $1, depending on the terms of the financing agreement. Versus a loan, on the other hand, which is obtained with the purpose of purchasing the equipment outright, with installments throughout the term of the loan. The equipment being financed would actually secure the loan in that case. And at the time of purchase, title work is completed and the business now owns that asset. If something were to happen and the business can no longer afford that loan repayment, the equipment will be collected as collateral if they have not already arranged for the sale. So a few key differences between leases and loans. Number one is going to be ownership. For a lease, the lender would hold that title until the end of that term, where the borrower would have the option to purchase the equipment outright. Versus a loan, where the customer will hold that title at the time of the purchase. Also, monthly payments are a consideration as well. Typically, with a lease, there's a lower payment, and the reason being is because less of the equipment's purchase amount is actually being financed, right? If at the end of the term, they would have to put down, let's say 10% to purchase the remainder of the equipment, it would equate into a lower monthly payment. Down payments are typically 0% a lot of the times on a lease. So if your customer is looking for a no down payment option, lease is probably the way to go. And then another difference would be soft costs. Typically with a loan, there's not going to be any financing involved in soft costs being defined as installation, shipping, training, that sort of thing, versus a lease, which oftentimes would cover all of those soft costs. Now I'd like to go into some of the use cases, types of equipment, strategic goals where equipment financing would be a good fit for your borrowers. We can finance everything from trucks and trailers, medical equipment, computers and IT equipment, POS or point of sale technology, construction equipment, think excavators, bulldozers, landscaping machinery, industrial machinery, agricultural or farming machinery, seeing a lot of tractor loans come in now, as well as commercial printers and renewable energy equipment, such as solar panels. We offer equipment financing for many more types than that, but those are a general idea of the types of equipment financing that we're seeing a lot of these days. Some of the goals that we see come in. We're talking, what is the borrower looking to accomplish, and why is equipment financing a good fit for them? If they're concerned about cash flow preservation, for example, financing would allow the small business owner to put less money up front. And like I mentioned before, no business wants to use all of their liquidity to purchase a piece of equipment, right? Purchasing a piece of equipment outright with a lump sum payment can oftentimes expose them to risks associated with payroll, marketing, unforeseen business expenses, or deprive them of the capital that they need to take advantage of a new opportunity. So financing is a great option to allow them to preserve cash flows. Other considerations are convenience and speed. When using equipment financing, the process is a lot simpler. The application process and approval process is a lot simpler than a large term loan or SBA loan in most cases. Equipment financing can often offer 100% financing. So if an initial down payment or a lump sum purchase isn't exactly at the highest of what they're looking for, equipment lease would be a great option to allow them to acquire the equipment they need to grow or continue operations with a minimal down payment. There are flexible terms associated with financing. For example, a lot of the times when we get an equipment lease or an equipment loan approval, they can choose the term length from 3 years to 10 years. And there's flexibility in payments a lot of the times with some of our lenders and investors that'll allow them to account for busy seasons or slow seasons. So there's flexibility that loans won't allow. A huge consideration is tax advantages. So financing will help reduce tax liability and can actually be used to qualify as an operating lease for tax reporting purposes using tax code section 179. And under the Tax Cuts and Jobs Act, the annual deduction limit is 1 million. Highest annual investment limit for qualifying equipment purchases is 2.5 million. So business owners that use equipment loans can a lot of times get tax benefits, as well as depreciate equipment on the books, which can lower their tax burden as well. That's a huge consideration. Another consideration is innovation and upkeep. Equipment upgrades can be costly, and financing will give a business an option to get the equipment they need or make improvements while maintaining that working capital reserve that they have. I always recommend looking at leases for equipment that may become obsolete, as it would allow for that business owner to use the equipment over that term with low monthly payments. And at the end of the lease, they can simply upgrade to newer or more efficient equipment. For example, in the case of a software as a service company or B2B company, probably don't want to purchase a laptop at the end of a 10-year term. So for that example, they could simply upgrade and then release the new equipment. So those are some of the general benefits of equipment financing. At this point, I'd like to dial in deeper into Loanspark's actual programs. Some of the pros of our equipment financing programs, leases and loans considered, are the loan amount. We can go up to $20 million. And in the case of cannabis financing, which is something we're seeing a lot of volume in now, we can actually go up to 50 million. The term lengths can go up to 10 years, which is comparable to even an SBA loan or term loan. But we can offer 100% financing in a lot of these programs. We can finance new and used equipment as long as it's 10 years old or less. We can finance titled equipment and non-titled equipment. And we have a low minimum FICO required. So any FICO over 500 we can consider. And then we just do a soft pull on credit with the application. One of the cons of equipment financing is that not all industries would qualify. For example, firearms and casino gambling industries are industries that we're not seeing a ton of success with. But if you have scenarios like that, feel free to discuss those with me on a one-on-one setting, and we'll see if there's a path forward that we can identify. In terms of borrower criteria for equipment financing, we've got a couple of categories, right? We've got a stricter category and then a preferred category. Preferred just meaning that it's got a higher success rate with our borrowers and our partners, And if you present those types of leads, they have a greater chance of getting funded faster. Keep in mind, though, anything to do with cannabis is, of course, going to be a little bit stricter simply because there's less lending options available to those types of borrowers. But in general, as a base requirement, we require not really any time in business. We can work with startups less than 2 years. However, they do need to be generating revenue and have business bank statements and be able to meet those documentation requirements that I'll get into in a minute. So bare minimum 500 FICO, monthly revenues 5,000 a month plus, and we don't require any type of entity structure to work with. However, we do prefer to work with an LLC or corporation. We also prefer to work with a business that does have 2 years or more time in business, which would be not considered a startup, and a 660 plus FICO who's generating 15,000 or more in monthly revenue. Again, if it fits anywhere in between those two, definitely feel free to submit the lead or call me, text me, email me for more information, and we can see if we can find a path forward for your borrower. The documentation requirements for equipment financing are pretty simple, actually. Again, as a Loanspark partner, you're not required to provide all of these up front. You can submit the lead or the lead information to me with just borrower's first, last name, email address, and phone number. However, if you want to be proactive or if you happen to have a file on hand, what we would be looking for is a basic credit application, an invoice, bill of sale, or quote, 4 months of business bank statements to establish or identify what revenue they're doing. And then the loan or lease would need to be guarantored by all the business owners. Again, we'll send the credit application once the lead's submitted, so you wouldn't need to worry about that. I'd like to jump into a few of the recent fundings that we've received here. So in the first scenario here, it was actually a semi-truck. It was a 2017 International 4300. It was a logistics company, and they purchased this semi for $43,740. As you can see, that semi was 6 years old, so it was a used piece of equipment. And the loan amount was $34,995, so about $10,000 down payment. The interest rate on this loan was 10% over a term of 60 months, so it was a 5-year term. And this particular customer actually spent about 2 decades running a trucking and logistics business in the Southwest. They found a great deal on a semi online, and then they came to one of our referral partners looking for financing. That referral partner, knowing Loanspark's fast turnaround times and streamlined application process, went ahead and submitted the lead form online. And within a week, we secured the loan approval for them on a 5-year term with their down payment amounting to less than 10%, freeing up that capital for payroll or other expenses that the business needs that capital for. Another funding we recently accomplished was for 3 commercial printers. This was an Affinia brand group of printers, and the industry was, of course, custom printing. In this scenario, the purchase price was $255 with all 3 of those units, and the loan amount came out to $205,000. It was at a 12.5% interest rate over 4 years, 48 months. And in this scenario, the owner of a commercial printing company came to our partner, who actually provides that business with consulting services, looking to expand and purchase new printers to work in a new, larger facility that they have recently started leasing. That referral partner sent us this customer because they trusted us with our financing process, our turnaround times, and our streamlined application process. And they were able to purchase 3 identical printers, which allowed him to capitalize on his busy season and increase revenues. He elected for a shorter term to pay the loan off quicker and was very pleased with the speed of the process as well as the flexibility to choose a term that worked best for him. So those are some of the recent scenarios that we funded. Of course, we do all types of fundings here at Loanspark. So what I want to do is open up the floor to questions. But before that, I'd like to go through our upcoming webinars. This is the second of our series. We covered no DSCR on bridge loans 2 weeks ago. Today, we've covered equipment financing. In 2 weeks, on Wednesday, May 8th, we'll be covering line of credit. And then 2 weeks after that, we'll be covering Successful Loanspark Partnership 101. This will give you an idea of what a successful partnership looks like and some of the tools and resources that we provide you guys. After that, we'll be covering on June 12th, term loans, and that's going to be a huge hit. Term loans are definitely in high demand. So that's what we have in the pipeline, guys. I'd love to open up the webinar now to questions and answers, Q&A. So I will open up